Hi, I'm Rick Kaler. Thanks for joining me. The president has fired the first warning shot, indicating that politicians are eyeing the tax advantage of the Roth IRA. For years, I've strongly encouraged maximum funding of Roth IRAs and 401ks. Clients have sometimes expressed concern that politicians would someday retroactively change the rules and strip the plans of their tax advantages. I've seen that concern as a possibility. For example, in 2008, Argentina confiscated the assets in IRAs and 401ks and replaced them with less than desirable Argentinian government bonds. But I've never really given that much of a probability. With the introduction of the president's 2016 budget, the probability of losing some Roth IRA tax benefits certainly has increased. Each February, the president submits a budget to Congress, which is about far more than just spending requests. It also contains scores of proposals and changes to the existing tax laws. One such proposal in the current budget would eliminate two tax advantages of the Roth IRA. The first change would required minimum distributions, called RMDs, for Roth IRAs as well as traditional IRAs. Right now, there's no RMD required from a Roth. So what this basically means, at age 70 and a half, owners of traditional IRAs are required to withdraw a certain percentage annually, often around 4%. They have to pay the tax due, and if they don't need the funds for living expenses, then they have to reinvest the remainder in a taxable account. The RMD denies them the option of leaving the money in the tax-deferred environment of the IRA and further compounding, which is wonderful with a Roth IRA because money comes out tax-free. So under the president's proposal, owners of Roth IRAs will need to start withdrawing funds annually at age 70 and a half. While there won't be any taxes due because contributions to Roth are post-tax, it will remove the funds from the tax-free environment, decreasing future returns by up to 40%. That's a pretty big deal. The second proposed change would eliminate tax-deferred inheritance of IRAs, sometimes called stretch IRAs, for anybody except spouses. All other inherited IRAs would need to be dissolved and the funds distributed and taxed within 5 years after death. This will really impact baby boomers counting on their parents' IRAs to assist them with their own retirement needs. The budget proposals also would end Roth conversions to any after-tax IRAs, limiting them to IRAs where the contributions were before tax. This will prohibit taxpayers with earnings above the traditional and Roth IRA threshold from making non-deductible contributions to a traditional IRA and then doing a Roth conversion, which has been very popular. Final proposal would limit new IRA contributions for total retirement savings, which total over $3.4 million. This includes the aggregate total of all IRAs, 401ks, any other pension plan balances. Once the total reached $3.4 million at the end of a tax year, no new contributions are possible to any plan. To many Americans, this looks like a cap they will never see in their lifetime. Yet consider what $3.4 million will be worth in purchasing power 40 years from now, when today's 30-year-olds will have to start RMDs. If inflation maintains its historical average of 3%, in 40 years, $3.4 million will have the purchasing power of just over $1 million today. If someone wants to be assured they will never run out of money in retirement, $1 million only provides $30,000 a year of retirement income that you can have pretty much a 90% plus assurance that the money will be there for the rest of your life. So capping IRA growth, it's another big deal. These are a few of the tax changes proposed by the president's budget. The chances for any of them to become law in 2016 are pretty remote, given that Congress is currently controlled by Republicans. However, the proposals do signal the current thinking of lawmakers. In considering their retirement planning, taxpayers will be advised to pay attention to these signals. Thanks for joining me.